Good morning, everyone, and welcome to today's lecture in Computational Finance. Last time we stopped after some examples of optimization with constraints in MATLAB, and let's now turn to some practical issues with portfolio optimization. Now, first, I wanted to show you the results of one paper that is, it's almost 18 years old. It's a paper by Rockefeller and Uryasev in the Journal of Risk, and I particularly like this paper because it has a little twist in the end, and you might recognize this afterwards. The idea here is that Stan Uryasev, who's a professor at the University of Florida, he argues that he's the one who invented conditional valued risk. Conditional valued risk, we'll see that later on, is, as you probably know, the expected value of the losses conditional on the losses being higher than the valued risk. One can distinguish different variants of the expected shortfall or conditional valued risk. Actually, there are three risk measures around: conditional valued risk, or CVaR, expected shortfall, and or tail VaR, or tail valued risk. All three are almost exactly the same, with the exception that they are defined in a slight different way, so that if you look at discrete random variables and continuous random variables, they are not exactly the same, but economically they more or less are. Now, here we are dealing with optimization of the conditional valued risk, and we start by taking a function f of x and y being the loss associated with two vectors x and y, being elements of the n-dimensional real space. We'll later on see that x and y are actually a portfolio weight vector and a vector of P&Ls, of profits and losses. Now, the probability that f of x and y will not exceed a certain threshold, alpha, is just given by taking the integral over the probability density function of this function f, and you simply assume that f should be smaller or equal than alpha, and then you just integrate over the probability density function p of y. Okay. Now then, here you can see the definition of the valued risk and the conditional valued risk. The VaR is simply defined by the minimum alpha element of the real numbers, so that this function phi is larger than or equal to beta, which simply means that it's a quantile. Conditional valued risk is then just f times the probability density. Take the integral and take it by 1 over 1 minus beta, which again shows you that this actually is what? It's an expected value in a continuous case. Remember that in the continuous, or the case of a continuous random variable, the expected value is nothing but the integral of the function, of the probability function f times x itself. And if you take the integral from minus infinity to plus infinity, this is the expected value of x. In this case, it's a conditional mean, and you can see this here because you are taking the integral not from minus to plus infinity, but just over the space and just over the area in which the losses are actually higher than the valued risk. And this means that this is more or less the expected value of x, conditional on x being larger than the valued risk. So you can see this here. It's a conditional expected value of the losses exceeding the valued risk. And in fact, this is also usually referred to as the expected shortfall, or ES. Now, Rockefeller and Uryasev define the following function. Capital F, that depends on beta, a function of x and alpha, and it's given by alpha plus 1 minus beta to the minus 1th power times the integral over all y, element of the m-dimensional real space, of this function f. Actually, it's the positive part of this function f, If you ever see this and you don't know what this is supposed to mean, it's quite simple. It's actually x if x is larger or equal than 0, and 0 if x is smaller than 0. So you just take the positive part of x, or set it to 0 otherwise, times the probability density. And at this point, we have no clue what this function is all about, but we'll see, we'll later on see what is meant with this. We can see, actually, there's one k, this function f is convex, and it's continuously differentiable in alpha, and the beta conditional var, so for example the 5%, the 10%, the 1% conditional var, depending on x, simply is the minimum of this function f. So if we take this function and we minimize it, we get the beta CVaR for this function. Okay, and you can now probably guess what happens if the function is convex and it's continuously differentiable. We know that first of all we can use a gradient-based method, and second and most important of all, if it's convex, there is only one global optimum. And the final result of this paper is actually that if you do portfolio optimization with conditional var constraints, there is only one global optimum. No? So the conditional var actually has a nice feature that if you do portfolio optimization, in fact they do it the other way around. They don't do portfolio optimization by maximizing portfolio returns and having a var constraints. They actually take the other way. They minimize conditional var and fixing a minimum portfolio return. But if you do this, and you know that the CVaR function is convex, they show that actually here you have a global optimum. You will always have just one single optimum. And you can illustrate this in the following. Let x be a vector of portfolio weights, just with the usual assumptions. X, y is larger than 0. The sum of all portfolio weights should add up to 1. Y, J, is the yield or the return of security J. Distribution of returns Y is independent of the portfolio weights. Then actually the loss from the portfolio is given by this function f. You insert the portfolio weight vector x and the vector of returns y. And if you take, for example, minus x times y and the portfolio vector is transposed, this will just look something like this, for example. If you take it like this, then you see that you will just get a portfolio return or a portfolio loss here as a result of this function f. Now, we take the function f capital. In this case, it's a performance function. You can see that we combine this with the idea of the conditional var. And again, this function f is now, of course, in this application also convex. It's continuously differentiable in alpha and x. Now, if m is the expected value vector and v is the covariance variance matrix of y, you can see that the expected values and the variance of the portfolio are simply given by minus x times m and x transpose times v times x. And we want as an additional constraint that the portfolio return is at least as high as this minimum value minus r. And all constraints, the target function, everything is convex. And the result is that now, of course, optimization is quite... Oh, I've forgotten to translate this. Now, the result is quite simple. Portfolio optimization can proceed as follows. You minimize the var, the CVaR, under the constraint that the portfolio return yields a certain minimum return, And this optimization problem is convex, as the constraint and the target function, the objective function, are all convex. So there's exactly one local/global optimum. And you can show this. Okay. Now, this is an example of how convexity can come into play. Before turning to a real example with real data, I wanted to highlight some results from Markowitz portfolio theory, and you should remember this when we look at the optimization with real data. Now, remember that in the case of the n-security case, the efficient frontier or the efficiency line of Markowitz, how does it look like? Again, remember, mu is supposed to be the vector of expected returns, sigma is the vector of standard deviation, C is the symmetrical n times n covariance matrix of the returns, W now is the vector of portfolio weights. Again, the weights should be larger than 0, they should add up to 1. And if we do have a weight that is less than 0 and it's negative, this is a short sale. With a fixed weight W bar, the expected portfolio return is just mu p bar equal to the sum of all Wi times mu I, and the portfolio return variance is just the weight vector times the covariance matrix, again times the next weight. Now, the vector that satisfies Markowitz efficiency must be determined. What do? We try to minimize the portfolio variance. And we have the constraint that the portfolio mean return is fixed, it's constant. And we assume that the portfolio weight vector is actually, it adds up to 1, the standard assumption here. Standard Lagrangian approach yields that you have to minimize this expression here. This is just the Lagrange approach. You minimize the objective function plus lambda times each constraint. See this here, those are the constraints. And we solve it by taking the first derivative, setting it to 0, and if we now solve for W, the optimal portfolio weight vector, we can see that W should be given by nu times the inverse of the covariance matrix, and so on. If we now use both constraints, we get now this is the first condition. If we take the second condition, it gets a little bit more complicated, but again, you simply take the derivatives, the first derivatives of both the constraints. You can see this here, and if we set it in and we set this to A, this to B, and this is again B, and this is D, we get, actually, if you look at this, we get nu and lambda. This is actually a system of linear equations that is given by this, and A, B, and D are defined here. And with a little bit of algebra, we get these results, lambda and nu, and in the end, if the special case A and B is equal to 0, the portfolio variance is minimized without making any demands on the portfolio return. And in this case, if we don't set a constraint on the portfolio return, we get the minimum variance portfolio. And you might remember this actually here. This is a famous result from portfolio theory, that the vector that yields the minimum variance portfolio is given by this expression. Okay, so you just need to remember that if you're interested in the minimum variance portfolio, you don't actually have to do a real portfolio optimization in this setting, in this framework. You simply take the covariance matrix and you take this variable D that is defined by actually this here. You just need the inverse of the variance covariance matrix. Okay, so this is portfolio theory. If we insert it into the formula of the portfolio variance and portfolio return, we don't just get W for the minimum variance portfolio, but we also get the mean return and the standard deviation slash variance of the minimum variance portfolio, which in this case, again, is just using this, actually this should be varmin, of course, the vector of the minimum variance portfolio and taking the covariance matrix and the vector of mean returns. If we now insert this in equation 1, and you do remember that actually the minimum variance portfolio is the starting point of the efficient frontier. And if you have the minimum variance portfolio, you can actually insert it in equation 1, and you get the following equation for all Pareto or risk efficient portfolios. That is, you get the equation that yields all those portfolios on the efficient frontier. Now we'll later on use this simply to plot and to highlight all those efficient portfolios. Okay, so we have, from Markowitz theory, we have the definition for the minimum variance portfolio and the equation that gives you all risk-efficient portfolios in the efficient frontier. Now let's take it to the data. We are looking at the share prices for 7 DAX companies: Adidas, Deutsche Bank, Deutsche Post, RWE, Siemens, ThyssenKrupp, and Volkswagen. Source of the data is Yahoo Finance. One has to stress that this is a quick and dirty solution, and you should resort to more professional tools like Bloomberg, DataStream, etc. But for this purpose, it's totally sufficient. These are closing prices from the Frankfurt Stock Exchange, adjusted for dividends and splits. And here you can see the time evolution of the prices. As you can see some dramatic changes in the stock market. First of all, you can see the financial crisis between 2007 and 2010. You can also see that stock markets have appreciated and increased a lot since 2000. And what else can you see? Is there something else going on? Yeah.
Financial crisis in 2007 or 8,
yeah,
or something.
Yeah, we can see the financial crisis. Anything else when it comes to one particular stock? Yeah, the diesel scandal. Yeah. You can see how the stock of Volkswagen crashed from above 200 to just close to 100 as a result of the diesel scandal. Okay, there is one downturn here by Adidas. I have no idea. I have an idea. I have an idea what might have happened to the stock of Adidas. Might be. If you are, I think the stock increased just until 2014 and afterwards decreased. It might be. This is a wild guess. Might be that it's connected to the Soccer World Cup. So that the stock increased up until 2014 when the Soccer World Cup took place, and afterwards just decreased because investors were expecting revenues to go down. But this is not too dramatic. Okay. Now let's first start by computing daily log returns. M is the number of days, N is the number of stocks. Now assume we have uploaded and inserted our data in a matrix price. Now M, N equal to size of price gives you the size of this matrix. So M is the number of lines, and N is the number of columns. So you have a structure that, for example, you have Adidas as a column, RWE, and this is the 1st January in 2001. This is 2nd January, and so on. So you have M lines and N columns. Then return is defined simply as a matrix with zeros, with m-1 lines and n columns. Why do you need only need m-1 lines? Well, as you can see, the first line is the header, and you don't need the header because you will probably remember which stocks are in which column. Okay, then we calculate the daily log returns for I equal to 1 until m-1. Return I is given by a log of price I plus 1 minus log of price at I. This is just the definition of a log return. You could have done this in Excel and then uploaded the data from Excel to MATLAB, but here I've done it all in MATLAB. And the returns in percent are just return equal to return times 100. Okay. Now, one good idea is always to look for outliers. If you do an analysis like this, you might be interested to exclude outliers. Why? Because outliers, extreme values, might disturb your analysis and might disturb your estimations. It's a tricky question when to exclude outliers. In some cases, you are actually interested in those outliers. If you're interested to model tail risk, if you are interested in modeling the extreme behavior of this return series, there is no reason why you would exclude outliers. Here, in this case, because we are interested in portfolio optimization, I thought it to be a good idea to exclude outliers. Here, in fact, you simply tell MATLAB to go through the returns, and if it finds a return that is larger than 20 or less than minus 20%, it should mark it, and then you can see that you actually delete, first of all, the index entries, and then you delete the outliers. Okay. In fact, out of these 3,722 days, there were 4 days with outliers, probably during the financial crisis. Okay. Now, let's calculate all those parameters for portfolio optimization in Markowitz. We take the expected values, the covariances, and actually this is quite simple. Mu is mean of return, C is COV of return, and C1 is just inv for inverse of the matrix C. So we have mu, we have C, and the inverse of C, and this is actually, these are just 3 lines in MATLAB. Then we can calculate those parameters A, B, and D from one of the previous slides. A, B, and D. It's not very difficult. And we can then go on and calculate the weights and the weight vector of the minimum variance portfolio. So W varmin is given by 1 over D times the inverse of C times a vector of 1s. And you can see those weights here. 34%, minus 13%, 31%, 29%, 9%, minus 4%, 12%. Actually, you can see that for 2 stocks, we have short selling. And the corresponding return and the standard deviation are sigma min and mu min, and you've seen this on one of the previous slides. Theoretically, it's just 1 over the square root of D and B over D. Now, we also have the equation, the definition for the efficient frontier. So sig map and size and mu p1, mu p2, it's quite simple. You simply calculate all those different efficient portfolios. So you start with the minimum variance portfolio, you take the equation, insert the parameters, and you try to calculate this. And in fact, it looks like this. You can see that the definition, of course, includes both the efficient frontier on the upper side, and it also includes those portfolios on the frontier that are dominated by the ones on the upper half. So here you have the minimum variance portfolio, and of course the blue line is the efficient frontier. And it's quite interesting to see that this you can construct this with real data and the equations from portfolio theory. and it looks actually just like the lines and the half actual I've shown you before. Okay, now I pretty much like the next part. One could think that, okay, let's start with naive diversification. Let's simply put everything into each stock with a fixed weight, or even better, just use random weights. Yeah? If you go to a broker and you want to spend 10,000 euros, you could think about putting 1,000 euros here, maybe 2,000 euros there. So let's do a random portfolio. And this program does this. It simply constructs 2,000 random portfolio weight vectors. So I is 2,000, W is a vector of zeros. For I equal to 1 up until 2,000, W, small w, is again a vector of zeros. And while sum of W is larger than 1, for J from 1 to n minus 1, W at point J, at index J, is rand. Rand 1 gives you one random number between 1 and 0. I might have mentioned this. First of all, a computer can never generate random numbers. Random is something, and randomness is something a computer cannot do. Yeah? This is quite clear. It can only do things we have programmed it to do. So those algorithms that are being used are so-called pseudo-random number generators, because those numbers look like they are random, but they actually aren't. And how can you see this? Quite simply. If you were to start the computer again, and if you were to set the random number generator back to its default state, you would again generate exactly the same numbers. A random number generator always needs a fixed anchor from which it has to start. And afterwards, it has very sophisticated algorithms that try to mimic randomness. But the computer always needs a starting point, a starting value. The starting value might be different from computer to computer, but as soon as you restart and reboot your computer and reset this random number generator, it will again generate the same number. You might want to try this out with your calculator. I would assume that you will see the same result. Start it over, and you will see the same random number, and the sequence is also fixed. Yeah? So this is quite interesting. And rand 1 simply gives you one random number between 0 and 1. If you're interested in a random number between minus 100 and plus 100, you don't need a random number generator for this. You simply take this random number between 1 and 0 and you transform it to the interval of minus 100 up until 100. Yeah? So this is absolutely sufficient. And afterwards, you can see what I do is I generate, for example, 9 random numbers, and the 10th weight is just 1 minus the sum of the previous 9 weights, and this makes sure, and this assures that the sum of all weights is 1. Then, pretty simple, we simply calculate the daily portfolio returns and we plot it. And this is the vector of the expected portfolio return and the standard deviation, and I want to include this in the plot. And again, remember, these are 2,000 portfolio weights, so you had ample chance of picking the right one. And look where it gets you. Most of them are highly inefficient, and not a single one is on the efficient frontier. So simply using a random weight vector will cause you a lot of pain financially. Do you have a question?
Can you do this that you never have the same random numbers? I mean, if you really use this number generator for something important, you just your system restarts. It might be a big problem if the same sequence comes out again.
First of all, I would assume that there are more sophisticated pseudo-random number generators, And when I first heard about this and I first read about this, I was just startled and surprised by the fact that actually this is a research field. I mean, there are people in computer science and mathematics working on getting and finding better and better pseudo-random number generators. But, of course, again, these numbers are random if you simply single out a sequence or one or two numbers out of them. So if, for example, you take the 10th number and you're looking at the 11th number, it is more or less random. You know? But you have to remember that the computer cannot throw a die. It can simply, dice. It can simply use a starting anchor point and then use a sophisticated algorithm to come up with something that to us as humans appears to be a random number. You know? But the computer can always reverse engineer those numbers, and it can always construct these numbers again and again. You know? So one has to keep this in mind. And here you can see that actually those random portfolios will not get you anywhere. So not even a single one out of 2,000 random portfolios is even close to the efficient frontier. Okay, why are the random portfolios so inefficient? In fact, if you take a closer look at this, it's actually a little bit unfair. The random number is taken between 1 and 0, meaning no short sales. So if you don't allow short sales, and one would assume that at least you as a retail investor cannot short sell. If you don't have short selling, you will probably not get close to the efficient frontier. No? We've seen this with the minimum variance portfolio. Here, 2 stocks are already in short selling. Okay. Now, it's probably due to this fact that we are including inefficient stocks and we have no short selling. Now, one can go on, and first of all, you have to remember that you cannot optimize, maximize return, and at the same time minimize variance and standard deviation, volatility. What you can do is you can try to look at a function that gives you the utility of your portfolio, and you have to make some assumptions on the risk aversion of your investor. So what you can do is you need some information on your individual risk preferences, and you can come up with a utility function. For example, in the following, we'll be using this utility function, which is a standard utility function. That is, we are interested in a high mean return, and the standard deviation, or more precisely the variance of the portfolio return, is a negative thing, and we have a risk aversion parameter of 1/50. So this here is our A, this is our risk aversion parameter. Okay. Now, what can we do now? We can try to maximize this utility function, and we can try to find the best and utility maximal portfolio. This is a nonlinear function, so we will be using fmin_con, and we try to minimize this objective function by taking -phi. Again, remember that all standard functions in MATLAB minimize, so as we want to maximize the utility function, we have to minimize -phi. This is actually quite simple. Take the standard deviation of the stock returns, we'll take the correlation, the objective function is phi at of x minus x times mu minus 0.02, that is 1/50, and then we'll calculate the variance of the portfolio, which is given here. And we actually need one constraint. We could, of course, include many more constraints, a CVaR constraint, something else, but the only constraint we are considering now is that the weights of the stocks must add to 1, and without short selling, the portfolio weights have to be non-negative, and we require a starting point or a starting vector that satisfies all constraints. So we are using as a starting value 1, 0, 0, 0, 0, 0. So investment is done in Adidas. We have no constraints here. We have one constraint here, that the stock weights have to add up to 1, and we are not allowing short selling, so the lower bound is a vector of zeros. And then F min con phi starting value A, B, A equation, B equation, lower bound, upper bound, and you can see that as a result we get as an optimal portfolio weight vector 62%, 0, 7%, 0, 0, 0, 31, 32%. And the optimal value of our utility function now is 0.0016, whatever that means. Actually, we can compute the portfolio mean return and the standard deviation by inserting this portfolio weight vector into the defining functions and the equations, and we get a portfolio return of almost 5% with a variance of 1.6. Now, again, this optimal portfolio lies on a preference function, phi star, from the set of all potential utility functions, and we can plot this. Actually here you can see how you can plot the preference functions, which is the indifference curves, and obviously the optimal portfolio should lie on this preference function. And here you can see this is actually the portfolio we have optimized, and it is on this red indifference curve. So for example, the investor would be indifferent between a portfolio that is here or a portfolio that is here. And I have to go now, but you can have a look at the following next 2 or 3 slides. Why is it not on the efficient frontier? Again, no short selling. If we allow short selling, we get a better result. How is that? Quite simple. We do the very same and we just allow for short selling, as you can now see, some of the stocks. For example, the second and the last one and the fourth one, they are actually sold short. And you have a short position in these. And the result is just that you move to a higher indifference curve. So utility is increased, and you are now able to get this portfolio, and this is the famous result of the case in which you have no risk-free interest rate. If you have any given investor, he will choose an individual investor-specific portfolio on the efficient frontier. Which portfolio does he or she choose? The tangent portfolio of his or her indifference curve with the efficient frontier. And you now know that if you would also include a risk-free rate, this result vanishes and changes to what? You would have to take the risk-free rate, for example here, and you would choose the tangent portfolio with the line that starts in the risk-free rate, and for example, then all investors would choose this portfolio. But I wanted to show you that even with a simple example of 7 stocks and some real data, you can simply construct all those results from Markowitz portfolio theory. And in this case, you can see that by allowing short selling, you can increase utility by moving to a higher indifference curve and taking the portfolio that is the tangent point of your indifference curve with the efficient frontier. And finally, you have a portfolio on the efficient frontier. Not by taking a random weight vector. You might try this at home by using random weights, but by allowing short selling, and I am pretty sure you will get some portfolios that are here and not just here. But I would be surprised if any portfolio is actually on the efficient frontier, because you have to do a proper optimization to get there. Okay, so final result, and this is my last point for today. This is a very simple model that shows you that actually short selling can be beneficial. And by restricting short selling, you are forcing market frictions, and you're constructing market friction and market inefficiencies. And this is quite interesting because during the financial crisis, the SEC actually banned short selling on financial stocks. And later on, researchers found that it only deteriorated market liquidity, but it did not have a beneficial effect on investors. So this is quite interesting, and you can simply see this here because, as you can see, by banning short selling, you simply move to a lower indifference curve, and suddenly utility is decreased. Okay. Any questions? Okay, so if you have no questions, thank you for your attention and see you